All right, hello. Um, this is a weekly recap for April 14th to April 18th from me. And so we're going to be looking at the NASDAQ today. Um, just a quick sort of briefing in my journal. My personal journal, I was looking at this week expecting a consolidation or some sort of slowdown in price, specifically because we had the week before and the week before that was just very volatile. So can expect some sort of slowing down, at least not a continued sort of pace at what we were for the past 2 weeks. It is Good Friday right now, as I record this, or while I was taking these screenshots. So we did have a market holiday, and the economic calendar for this week was Monday we had medium impact at 1 p.m. Then Tuesday we had Empire State Manufacturing Index, and Wednesday we had retail sales at 8:30 a.m. and then Fed Chair Powell speaks at 1:30 p.m. So that was kind of the highlight of the week for me. And then Thursday we had unemployment claims at 8:30, but the only thing is that Friday was a holiday, so it's best to just slow your hand down, or at least just expect less of price movement, even though it might actually book targets. But as you can see in the presentation, that there was really no higher high or lower low made. So it was an inside the range type of day, and dollar was no help. So as you can see, we do have the 1 minute buy side liquidity formed at 6 p.m. right over here. And we do have this 1 minute sell side liquidity formed at 10:30 a.m. from the previous week, specifically on April 11th, 2025. So I just have this for logging purpose. So you have this easily pulled up whenever you want. And then over here on Monday, we do have the 15-minute fair value gap SIBI coupled with a volume imbalance at 9:30 a.m. So you'll notice how a lot of the 9:30 a.m. 1 minute candles will have an impact on price. In this example, this one was used perfectly as a bearish fair value gap, and so we did not really violate this high because this was a very clean stop run. So we had a stop run, we had a shift in market structure below this low, fair value gap. We come up, reprice to the high, immediately drill lower, fill in the new week opening gap low, and then we start to just kind of consolidate, coming back and pulling into the range but to the low, so still respecting it. And then we have the new day opening gap, and so before I get ahead of myself, we have this dealing range identified. And so why is this a dealing range? Well, if you go on your own chart and look at the 1 minute candle, it is on April 10th, 2025. The 1 minute candle high at 3:11 a.m. during the 6 p.m. candle over here, if you can see my cursor, this candle gaps up and trades higher, basically sweeping any liquidity above that high, so it meets the criteria for a dealing range, having a high swept, and then this low over here also swept another low. So we have somewhat of a fresh dealing range to operate within. And just because this high is swept over here does not mean I'm going to drag my fib to that. That is the dealing range that the market is going to operate in. And if you take this high, you lose the precision aspect. So it's basically the equilibrium is going to be perfect where it's placed using this high and this low. Now, if you prefer this, there was a point in time where I actually did prefer that just because I felt it was a little cleaner, but then I started to notice that there was more precision in the high that is basically swept. So not the high that sweeps, the high that is swept. And then obviously this is the opposite side of the dealing range, which is the weekly target. More of a daily target, but yeah. Next slide. We do have this volume imbalance here, which I'm going to zoom in a second, but I highlighted this even though I did not view this real time. It's nice to add because it adds sort of a confluence to the idea that the market came up into here, reprices to the high, gets immediately smacked lower to the equilibrium. So now we kind of have the idea of an implied dealing range. Even though this is really not implied, but it's kind of like you can still use this level over here as an equilibrium. So notice how the market reprices to the high, comes lower, goes immediately to the equilibrium of that dealing range. So then off of there, pulls back into the range, trading to the low of that imbalance or that gap. And then next day, fast forward, over here, we trade to it. We do have these 3 series of up close candles with a volume imbalance between the close of that candle and the open on that one. So very nice. Anything else if I'm forgetting here? Obviously, the upper quadrant will always have the best shorts, and you can see how that's forming based on time, meaning Tuesday. So we had Monday's trading, we had Tuesday's trading, and right over here is the highest probability short. Even though you don't see any sort of, I don't want to use this word, but any profits till later on. You don't see any movement in your favor till later on. Once again, I was not trading this week, and I'm just doing this for logging purpose. I think it was an interesting week. We did have pretty good move, but it was very nice. It was very algorithmic, and it was clean. So I just like to include this in my YouTube. All right. Then we have that volume imbalance. You can see that there is actually a gap there. And while we do have this gap here, I prefer this one just because it's coupled with the order block, the bearish order block. So there it is, that gap. It's very small, about 135 about to 19137, not even, just a little bit below 19136, and then a little bit above 19136. So to take those levels, extend them out, and you see how we hit it once and never came back to it again. So it was never even referred to later on in price. Then this is something that's like what I like to refer to as a constant in price, meaning it'll always be there. It's just about whether you draw it or not, if that makes sense. It's that small, tiny little gap right here. I'll pull it up in a second, but you can see if you take that, what that level is the 1 minute weekly first presented fair value gap. So ICT spoke about this at some point in time, but it's kind of an obvious once he started speaking about the weekly first presented fair value gap. It's fractal. It's all fractal. So you could do it for the month on a daily chart. You know, what's the first fair value gap on a daily chart? What is the first fair value gap on a hourly chart? What is the first fair value gap on a 4-hour chart every 4 hours? What is the first fair value gap on a 30-minute chart, 15-minute chart, 5-minute chart? It just really depends on what sticks best with you. I like to do it on 15 and 30-minute. I think 5-minute is just too... You'll have too many drawings on your chart, and then it'll start to blur your actual focus. At least that's what it does for me. And so I stick to 15-minute and then 30-minute, and then obviously higher time frame like daily and weekly. So that means that this is the first presented fair value gap for the week. So when Sunday opens, we have this gap right here, but we also have this candle. So 6 p.m., 6:01, 6:02, 6:03, 6:04, 05, 06, 07, 08, and then 09. So you can see that's the first candle with the gap, and bada bing bada boom, draw that out. Notice how it's not supposed to be a buy side imbalance, sell side inefficiency, but I still annotate it as a buy side imbalance, sell side inefficiency, because I want to know what its original classification was, and at a later time this is essentially just a inversion fair value gap. So you'll notice if you go back, it kind of just goes sideways for that gap until it officially leaves it, also leaving a gap here right above the 0.75 gradient, which is a signature, and then it never comes back in there, so that's breakaway gap right there. But you can see how it essentially reclaims it, books that, then consolidates. But each time if you're watching this live, you're not trying to trade off of that necessarily. You're using it as like a barometer, and you're kind of measuring when it gets above it. Okay, it's reclaimed because its original classification is buy side imbalance, sell side inefficiency, and then when it gets below it, it's inversion. So that's kind of how the classification aspect of it all works. It's not super complicated. Maybe that's just what I've picked up over my years. Just kind of like how I try to stay organized. It really helps me because I can instantly sort of think of this image and think, okay, this whole entire range using this low and this high, if we pull up any further to 19,110, which we did right here, it's kind of keying back on that 1 minute chart, and it's using like old highs and old lows extended out in time. It gives you a good range. And if you take 19,110 and 1940 and extend that out, you have a very, very nice little optimal short range. And in other scenarios, you'll just have a very nice like a buy or sell zone, basically. So not saying that you sell there immediately or you buy there immediately, but it helps you create a live understanding on what side of the market is being respected, and that would be the premium side. So it's respecting the premium raise, and that basically tells us that yes, the market wants to go lower to the opposite end of the dealing range. So next day we gap lower, and then we trade down to the 0.25 quadrant. You can see wick, and then rallies up into there during the London session, books the gap inside there, and I think fails to trade to the consequent encroachment. And it's a consequent encroachment because the gap is there. So in terms of market structure, we have this large series of down close candle. That's probably the most apparent one, and that's why I'm using it. But paired with that, we have a high, and then we sort of have a low here. Oops. Let me go back to that. And then we have a low here, and then eventually later on, even though it's not very clean, it's still the idea of the market structure. We have a higher high, and then eventually a break of structure. But even though we didn't see that market trade there and create that sell side, that is a liquidity void, and so there's no buying or selling in that zone from here to here. And then you can measure out your gradients there. You'll see that the lower quadrant was respected, and then that was during London, and then we trade lower. And let me go to the next slide. So back to the first half of the day, or sorry, of the week. I want to bring your focus to this new day opening gap, high and low. And this is how I use the new day opening gap, high and lows, and what I've been trying to train myself to see. Sometimes, I think the reason I'm making this video is just to log it, really. There's nothing exceptional about this week, nothing that crazy about this week. It's just, I like to do this on a weekly basis. And this is just my personal, I guess, the best way I can look at the new day opening gap and how I look at price. So I go back to these later when needed, like when I'm having difficulties viewing the market, and then I just kind of warm up using these ideas. So the way I view it is I look at the new day opening gap, high or low. In this case, it's 1, so the close is no different than the open. And so we do have this buy side here. So starting at really 8 p.m. is when you want to start looking. That is the start of my Asia session. Some people use the 7 p.m., but I just like to use 8 p.m. 8 p.m. to 12 a.m. essentially. So that would be 11:59 p.m. That's the Asia session or the Tokyo session for me. And I like to use, like I said, the 8 p.m. So 8 p.m., look back, buy side here, sell side here, right? We do have this sell side also, but this one is closer. And then, so you can see that during the Asian session, we tag buy side. Okay, so all Asian traders, all overnight traders who are in the US viewing the market, they see the market trades higher. All right, comes back in the new day opening gap, consolidates a little, forms buy side here, tags it, 3 a.m. So now London traders are seeing that the market is trading higher. Okay, we leave this side. So this side has now been made jagged, right? And we leave these two clean lows, right? So market goes up to a premium of the weekly or daily, or the I guess the daily, the dealing range that I identified at the beginning of the video. I'm sorry, my mouth is very dry. I have no water, and I refuse to get some. So anyways, we trade to a premium, and we sort of grind lower. slowly, but we grind lower. It's not a clean drop, and this is not a nice condition, I guess, because it's back and forth, back and forth, back and forth, and it's all eventually done to grab the sell side here in the form of clean lows. So we go there, grab sell side, and leave these lows intact. So we have an order block here. So price respects that order block, and then eventually tags the buy side here and the buy side here. So using this exercise, just from the Asia open to the New York morning session open, you've already sort of built a very nice understanding of what the market has done, who's being tagged for buy side, and who's being tagged for sell side. And eventually, after tagging the buy side and seeing the market trade up into this premium array, order block, volume imbalance, weekly fair value gap, that once again we're not using to short, but you can see that if you were to transpose down to a lower time frame, it goes up, it reclaims it, it goes up, it comes back down, so now it's inversion. All right, it comes up and hits it, and then it goes below, and then comes up, and then reclaims it, and then goes down, and then inversion. So it's just a tough condition for Tuesday. And so even though we had a nice price move throughout the day, if I'm being honest 100%, this is a choppy condition that I would not want to trade. And if I were to trade it, I would have probably gotten cleanly removed. So I'm glad I didn't touch this. Anyways, we have the clean lows down here, well, here and here, and these two. So these two are large pools of liquidity, partials below here, terminus here. That's kind of what I'm thinking. And the reason for that is because why I'm not using these is because it's just kind of asking for too much, in my opinion. And I guess the best way to explain it is that was not classified in our exercise. So we're not looking for the most of the move. We're just looking, this was sort of like built as an exercise. And this was the only pool of liquidity that was included in the exercise. So there's no need to really book this and book this. It's just if it books this. And as you can see, we gap down almost 930 to 748. So about 150 plus handles. And we do sort of essentially book that sell side right there. But we do have this 9:30 a.m. 15-minute fair value gap as a BISI, buy side imbalance, sell side inefficiency. And although we trade into it, and consolidate there, we eventually trade below it aggressively, leaving the signature of a breakaway fair value gap. And then we come up, hit it, hit it, hit it, hit it one more time, hit it one more time, close, and then gap lower. And then here's the second half of the week. So that's Wednesday and that's Thursday. So it was a 4-day week. So I had the first 2 days of price action, and then I had the second 2 days in this presentation. So you can see that we had that gap right here, the high and then the low, and we came up, and then we failed to trade to the consequent encroachment, but this is all done above the equilibrium. So there's no need to go to the consequent encroachment, and that would sort of be the underlying expectation of price, now that we need to go book this sell side. So it goes up in there, no need to book it. We essentially fill in the first or the lower quadrant of this gap, and then we come down Um, and so, taking a look at my notes, we have this buy side imbalance. Sorry, not this buy, this breaker, this bearish breaker over here. And it's a 15-minute breaker formed at 9:45 a.m. And the reason it's a breaker is because we have this high here, and why am I using this? Because it's inside the opening range from 9:30 to 10. So I like to use, when I look at those candles and price has traversed through it numerous times throughout this whole range, so we have went down, we have came up, we have came down, we've booked the sell side now, we have came all the way back up here. So if you mark from here, this high to this low, we're in a deep premium relative to that short term dealing range. Okay, so we're in a deep premium, and we've came back up to it. So we've delivered buy side, we've now delivered sell side, we deliver buy side one more time, and in the final run lower, we start to deliver sell side throughout this breaker. So this is essentially a balanced price range now. And so I look at this as a measurement for next week. This specific candle, I would take this high and this low and see where do we gap up on Sunday and where do my standard deviations place for that week. And so you'll see how I place my weekly standard deviation at the beginning of the week. So, that being said, notice how this is all done. This is 8:30 a.m. Sorry, 8 a.m. And then we have 9:30 a.m. and that delivers lower into this new day opening gap. So I was watching this new day opening gap trading higher around the Asian session, and then I was looking at this breaker, and I didn't really participate anything in the New York AM session, nor did I watch it at all. I didn't expect too much, but because this new day opening gap was touched over here a few times, and we were coming up into a deep premium, it's only reasonable to expect it to come back down, and so it did. So then also, because we're using this breaker from the 15-minute 9:45 a.m. candle, it's a good exercise to see where the 1 minute first presented fair value gap is, and that one was formed at 9:36 a.m. and it's the first presented fair value gap, buy side imbalance, sell side inefficiency, coupled with the volume imbalance. So because it's a buy side imbalance, sell side inefficiency, and we are trading up to it, expecting it to act as a what would be an inversion fair value gap. We don't have to, I don't label it here, you can, but I kind of leave it for my interpretation real time, because at any moment it could have traded up above here and then booked this buy side, but because we have this breaker here, it trades up into it and then goes and books that new day opening gap, and just for the cherry on top, it comes back down into that sell side, 18,270, books it, and then just does whatever it does here. So nothing interesting. Here are the sessions. You can see that every high for the week, every short-term swing high was either made during the London session or the New York AM session. And so, talk about algorithmic price action. That's pretty algorithmic. So it could have essentially booked during the Asian sessions, but it didn't. So, yeah. And then we have the standard deviations, 0 and 1, and then we go up one standard deviation of this Asian range. This is the weekly Asian range, sorry, the Sunday Asian range. We go up into it, one standard deviation above, book that turtle soup sell, and then we come back into the Asian range, and look at how price respects the Asian range high right there. So that's why my interest was there. That's why this is a inversion fair value gap, and it comes back up into there during the PM session, leaves this breakaway gap, gaps lower, and does everything on like trading into the new day opening gap and coming lower, and then we have that sell side there. So this is, even though this is on a 15-minute chart, the 1 minute sell side, it's derived from the 1 minute 10:30 a.m. candle. So yeah, this is a 15-minute chart, so you have a whole universe to explore beyond this. But I just wanted to warm up my skills, I guess, for the week, for next week, and expect an analysis if I have the time to record it. But I will be active in my Discord, and I will try to go live. I actually just prefer to not go live now because my voice in the morning is like gone, and if I talk anymore, then I just can't talk basically for the rest of the day. So I also don't get any views, so it's just not worth it for me. So I don't know. Quick little recap of my trading. It's been good. It's been a little boring, but that's a good thing, if anything. So if I'm not doing lives, I might do, I don't know, I've been thinking about video edits, kind of like 2-minute clips, 5-minute clips of a trade recording, but I don't know, I'm just kind of opposed to it, but we'll see. I might do some like funny edits. I just need to download an editing setup or software, and I need to set all of that up. So it's a lot of work, it takes a lot of time, and I don't want to devote my focus from the markets. I'd rather, if I were to do anything, I would rather do these reviews, and I would rather live stream. So yeah, I will talk to you when I talk to you next. Hopefully it be next week. And if you have any questions, comments, or concerns, please let me know. But yeah, and I forgot to mention, look at how we trade down to the -6 standard deviation and then have that beautiful reaction off of that. So really nice. These are all things that if you log over time, like I have, you'll start to see it repeat over and over and over and over and over and over. And it starts to get boring. And boring is not a bad thing. Boring is a good thing, because that means you're seeing it happen so often. So something I've actually been contending with in my own trading is that while I'm still very in love with the market, looking at old data is not what it used to be. I used to have like moments of epiphany and like moments of shock, or I guess the best way to put it is interstellar moments in my back testing. And now it's all just very, very common. Like it's, okay, I know I'd expect to see this, and I see it, or I'd expect to see it, and it's kind of just what happens in the back testing. So I guess maybe it's a dopamine thing. That's my best guess, but not as much dopamine from back testing, and so my excitement, quote unquote, has been coming from actual live tape reading. That's really where I excel, or not excel, but like I thrive and I really enjoy. But obviously there is always uncertainty with trading, and I'm just going to throw this in there. Trade at your own risk. I do not condone any buying or selling based off of these ideas. So, I'm like two minds where while I enjoy back testing, while I enjoy tape reading, I'm really I don't know, it's like I'm having a hard time finding the right happy medium between both. And so I'm taking my back testing to a new level where I'm gathering and collecting data, and I want to see on a 5-year basis, 10-year basis, 15-year basis if what I've gathered and collected from the past 2-3 years of trading these concepts, if they really date back that far. And so it's definitely a process. I'm not a coder. I'm not a computer specialist. And if I excel in anything, it is probably just trading and calling markets. And so I have no idea or clue on how to collect data, how to build a team and collect that data and then process it. It's a very demanding task, so that's kind of where I'm at. Anything else? Oh yeah, look at how that at the lower quadrant, when we're expected to book the sell side, and this is going to be the last thing, if we're expecting to book the sell side and we're in the lower quadrant, the idea is, and it doesn't happen all the time, but when it does, it does. Look at how the market goes down and books that sell side so fast, right as soon as it enters that lower quadrant. So super, super nice. Yeah. And that's going to be it for today. I hope you enjoy your weekend, and I hope you have a great rest of your week next week, and good luck and good trading.